Hello everyone and welcome to Financial JCL, here to help you on your journey to financial freedom. So today we're going to look at Aviva, the insurance company, and I'm going to do a review of the company and valuation. Now Aviva operates in several countries, notably UK, and it's very big in Canada as well. And a lot of people in the UK might know it as Norwich Union from back in the day, and parts of the organisation, although there was a bit of a merger in 2000, can be traced all the way back to 1696. So in one form or another they've been around for quite a long time, so it should be an interesting review. So I will have a look at their key fundamentals as I see them. I'll then take you through my decision making process to see whether it's a strong company from an investment perspective, based on what I look at in companies. I'll then look at the kind of buy price and compare it to market safety, and then based on that make a decision around whether I'm going to buy it now. Now just put the key caveat in there, this is me explaining how I look at stocks. Don't just copy me, do your own research, make your own decisions and take professional advice if you need to. So I'll start off by looking at the free cash flow for Aviva. Now, in terms of what I'm looking for, first of all, this free cash flow is positive, although you can see back in time in 2011 and 2014 there were some small negatives there, but it has been pretty positive since 2015 with sort of a baseline of about 4.5 billion of free cash flow. So that's looking okay. The capex requirements are very low, so what that means is the operating cash flow translates into free cash flow pretty much in its entirety, so that's good. But the trend is quite variable, so if you look at this on YouTube you can see it's up and down quite a bit over the last 10 years. There isn't a key trend or a clear trend. So in terms of the kind of the marking for this one, I'm going to give it 50% in the free cash flow box. Moving on, I then look at the net income for Aviva. The 10-year trend, again, is somewhat variable, but it is very much positive since 2013. But it's not above 20%. Now, insurance companies don't have net income levels above 20%. It's 6%, the most recent here. So I'll give that, I think it passes sort of the minimum requirements for me. Well, I don't think it gets high marks under the assessment for net income. So just looking at revenue, this perhaps more applicable for growth companies, but we'll have a look at it anyway. So the revenue is a little bit variable, but there's nothing too crazy going on there. So we'll move on. And then the current ratio doesn't really actually apply for insurance companies just to the way that they work. So actually, I can't apply my usual test there of having a minimum above 1 and ideally a current ratio above 2. So again, we can move on. Debt to equity, very important, especially as we are perhaps entering more unpredictable and troubled economic times. And I like my companies to have very low levels of debt. Now, I'm not saying they have to have no debt, because sometimes debt, especially when it's cheap, can be useful to grow, but it's useful to look at trends and what's the company getting with that debt. So the debt to equity for me has to be below 2, and ideally it's below 0.5. And Aviva has kind of dropped over time, so it was around about 1.1 in 2010, but for the last kind of 5 years or so it's been around about 0.5, so 0.54. So, and it's very stable. It's not dropping, but it's stable. So that scores quite well for me. That looks pretty good in that debt to equity area. So linked to that, we'll look at the interest coverage. So how well can those interest payments be covered? And that actually has improved recently. If you're looking in 2012, that was basically 1, and it's now up to 7 at the moment for the trailing 12 months. And I like it to be above 6, so that looks okay. Now, one of the important ones, which perhaps is a bit harder to quantify, but is very important when you're looking at those big long-term investments, and how's the moat? What is the moat? What sort of moat do they have? Now, if there is a big moat, and you might look at companies like Coca-Cola, you might look at companies like Facebook, they have moats of different kinds, but they're very big, and that may cause you to think, to put a larger position in that, take a larger position in those companies because they have some very good competitive advantages. Now, I don't think Aviva has a specific moat that I could easily and quickly identify. I'm just looking at the UK here, and I'll just take an extract from the YouGov website. 95% of people in the UK have heard of Aviva, and almost half of people have a positive opinion of them and very few have a negative. So that's pretty good. So they are a very well-known company, the third most famous in the UK. And I've used Aviva on various occasions. I've always found their customer service to be excellent, and they've always tried to be flexible and do the right thing. I think that's important because if you can use your own experience of a company, I think Peter Lynch is a big believer in this. If you can use your own experience and you find companies that are doing something really, really well, better than competitors, then that gives you an advantage over Wall Street, as it were. So I'm saying that my experience for Aviva is very positive. So yeah, I think they get some marks in the moat, but not a huge number of marks. So we're just sort of halfway at the moment, so I just wanted to flag up a few ways that you could support the show. So if you are looking at this one on YouTube, if you want to see more of this, do subscribe, and I release at least one video every week. And if you really like this format in particular, do let me know and hit the like button, and that tells me that this format's working and I'll make more videos like this. And if you've got any companies that you want me to review in this format, then drop your comments in the boxes below. That'd be most appreciated. Now, an alternative way to support the channel is via the Patreon site. So you can become my patron, a supporter of the site. And in fact, there are some VIP patron slots available, less than 20, and they are strictly limited. So if you'd like to do that, that'd be fantastic. And I'll leave the details below. Moving on, we look at the industry. Now, for me, the insurance industry is amazing because, first of all, it's large, and it's certainly something that would exist in 10 years' time, and it's a very consistent industry. And I'm going to give it full marks because if you think about certainties in life, insurance is absolutely one of them. Various forms of insurance, and that could be life insurance, car insurance probably being the obvious one. It's very much mandated in a lot of countries. It's fantastic, and it's not necessarily got a large amount of growth, particularly in the developed countries, but I think it's going to be there, it's going to be consistent, and it's not going to go away. So I think it's a great industry to find a good company in. So then I want to look at the return on equity. So a measure of how good the management is in terms of generating returns. Now, the return on equity is quite variable, but it does pass the mandatory level of above 8%, and it has done for the last 3 years. Now, ideally, I like my companies to have a return on equity above 20%, and that's, again, quite difficult to get in the insurance industry. The numbers here perhaps aren't reaching that level at the moment, but the trend is increasing, so it has improved. 2015, 6%. Only looking at 2017, 8%, 2019, 14%. That is generally a bit better than it has been, where it was a bit more variable in the early 2010s. So I'll give sort of half marks for return on equity. Now look at the dividend. Now the dividend is an interesting one because if there's a less mature growing company with a high return on equity and they are growing their revenue, then I don't want a dividend because the company may well be able to generate returns more effectively than I can. But Aviva doesn't fall into that category. It's a bit more stable, so I'd expect some kind of dividend here. And the information I'm looking at first of all is the earnings per share. It's relatively stable, sort of the last 6 or 7 years. And the dividend gets paid out of the earnings per share. And then I'm looking at the payout ratio. Now, payout ratio, you don't want a payout ratio that's too high because it means the company's paying out quite a lot of its earnings. There's not much retained for the company if they're looking to grow. But the other thing is if the payout ratio is very low, it indicates that the dividend has room to potentially increase. When we look at the history of the Aviva payout ratio, it's been quite variable. But if you look at 2019, it was just over 50%. But for the trailing 12 months, it's only been 17.3%, and that's because the dividend has dropped recently due to the virus situation. There is definitely room probably to triple the dividend based on the earnings per share levels. 3.6% dividend at the moment, but that could well treble. So you could be looking at 10% if current performance continues and the economy sort of stabilises. So there's a lot of upside here. So it has been decreasing, as we said, due to the virus recently, but there is some upside. So we'll put some marks in the box for that. So let's look at the price to earnings ratio, and it's 5. So that's very, very cheap. So this is a company to me that doesn't look like it's going to fail. Its industry is going to be around for a long time. The company itself's been around for a while. It's very well known, and its price to earnings is 5. That gets full marks in that value section. You won't see too many companies like this, and it's not one to get excited about. The company, it's very steady, but it's very cheap. And then look at the price to book. Now all the data I've got so far has been from the Morningstar website, and the price to book is 0.59. So again, this indicates below 1 you're actually getting very good value for money against the book value of the company. There's a bit of a discount there. So looking at the company there, that's 0.59, very good value. So I take all of that into account. It looks like it's a suitable company. So I now actually do the discounted cash flow analysis, and I'm looking at a 10% discount rate. So I've got an established portfolio, so I'm now looking for stuff that's going to grow at least 10%. So I look at the history of Aviva. I think they could grow at 5% a year. Now if they grow their free cash flow at 5% a year for the next 10 years, and then at the rate of inflation indefinitely after that, that leads me to calculate their intrinsic value at £17.14, and it's in pounds because it's on the London Stock Exchange. Now, by itself, that doesn't mean too much, but if I add in the current market price, which is £2.78, that gives a margin of safety of a whopping 84%, so well in excess of the 50% that I'd like. So this looks pretty hot. And a worst case scenario, I think there's a scenario you could say, do you know what, the free cash flow may not grow at all in the next 10 years and then go up with inflation after that. It could be very steady. So let's look at that kind of more negative scenario. And where that leads is to an intrinsic value of £11.83. If you calculate that in comparison to the market price, there's a 77% margin of safety. So my calculations are that this is a very undervalued company, and it does pass my tests. So looking at this, again, the pie chart, if you're looking at YouTube, does suggest, look at price to book and price to earnings. It's very cheap, and it's a very interesting industry that's going to be around. You know, it's always as certain as death and taxes, insurance. So is it better than my existing stocks? Is the key question. Actually, I already hold a position in Aviva, so that is my disclosure here. However, based on this updated assessment, I am going to increase that position because I think the upside is significant, and the price risk isn't a risk I'm interested in, it's loss of capital. I think that risk is low based on my assessment here. So I'm not going to add it to the wish list or set up any alerts, I'm actually just going to increase my position. That concludes the show for today. I hope you found the review of Aviva useful, and do get in touch with me if you'd like me to review any other companies. So in closing, I'd like to thank you very much for taking time out of your day to follow the show, and I will see you next time.